Due to the unique way that interest rates are moving right now, it's a frustrating time for both borrowers and for savers. Why? I'll explain that more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. You're either a borrower, you're a lender, or you're an owner. A borrower, a lender, or an owner. And depending on which of those you are, the term interest or interest rate means very different things. And right now, interest rates are moving in a very peculiar way, creating a lot of havoc and frustration for those of you that are borrowing, for those of you that are lending or savers, and for those of you that are owners. The truth is you're probably all three of those things at the same time. The one where most of your financial life is focused in, that's the one that when you hear the term interest rate, you're naturally going to think there. But the way interest rates are moving right now, whether you're a borrower, right? Interest rates mean one thing and it's frustrating you in a particular way. If you're a lender, that's a saver, then interest rates mean something else and you're getting frustrated. And then as an owner as well, interest rates are just creating a little bit of confusion and uncertainty about the road ahead. So let me explain what I mean by that. Well, if you're a borrower, that's pretty straightforward. You are borrowing money either to buy a house or make a vehicle purchase, some other sort of financing that you're receiving. You're borrowing money from the bank or from an institution. And here's the frustrating thing for you is, yes, there's been all this talk about inflation, CPI coming down, right? Even though we know prices are still rising pretty rapidly. But CPI is actually coming down, and therefore the Fed has had all this pressure and communication about they're going to start lowering rates. They already did once, and so how quickly will they be able to lower rates? You haven't seen, as a borrower, you haven't seen lower rates. You haven't seen it yet. And yet out there in the marketplace, we've seen lots of interest rates starting to come down. But when you're financing, when you're borrowing, you likely haven't seen that. You did for a moment, where mortgage rates almost were 8%. I don't have the chart right in front of me, but from that peak up until the Fed announced that they were going to reduce interest rates, you saw interest rates go from 8 or in the 7 range down below 6 for some of you. But as soon as the Fed announced that they were cutting their interest rates went right back up. The mortgage rates, 30-year mortgage rates, are now at 7% or a little bit above at the time that I'm recording this. And so if you're a borrower, you're probably scratching your head. You saw in the late summer, you saw mortgage rates starting to come down, car loans maybe doing the same, and you thought, okay, here we go, and the Fed's about to lower interest rates. Things are going to get easier for borrowers, and then they reverse course completely, okay? Why? What's the reason for this? Well, part of this, and I'll explain a little bit more in a minute, is because we're running such a high deficit and we are having to borrow so much money as a country, we have to sell a lot of bonds. And when there's a lot of supply and not as much demand, that's going to keep interest rates high. Someone basically needs to get paid, get a decent interest rate if they're going to lend us money. And so that is putting pressure on borrowing rates, on mortgage rates and car loan rates and financing rates. So frustrating time for you borrowers. You were expecting interest rates are going to start coming down. I'll get some relief, and that hasn't come yet. Now, jump over to lenders, okay? Lenders. If you're not borrowing, maybe you're lending. Well, we don't talk like that as consumers. You're a saver. And so you've got money in the bank, you've bought a CD, you've bought a treasury bond. That's actually you lending money into the financial institution, into the financial system, if you will. And so just by having money in a money market or buying a CD or buying a treasury bond, you've essentially lent money into the financial system, and then that money is going to be lent out and someone will borrow it and so on. Well, what's your interest rate? Your interest rate has actually gone down. Your interest rate has gone down. Typically, those lending rates are at shorter term interest rates. So your money market, your CD, those sorts of things are typically those interest rates that you're going to receive as a lender are going to be closer to those shorter term interest rates. And that's the one that the Federal Reserve actually gets to influence and control. And so they've lowered rates. And that's coming on the heels of a lot of rumors that they were lowering rates. And so I don't know about you, but my money market was pushing almost 5%. And now I just got the update. It's only paying 4%, not 4.5, not 4.35. It just updated the interest rate. It's paying 4%. I don't know if you've looked at CDs recently, but you can't find a CD over 5% anymore. Many of them are at 4 or even below. So as a lender or as a saver, you're now receiving a lot less in interest, even though the borrowers out there are having to still pay a high amount for interest. And then finally, as an owner, this kind of confusing, lukewarm, either hot or cold environment that we have for interest rates is creating confusion for owners, right? If you own a company, then the risk-free, which is one of the ways that stocks are valued, the risk-free rate of return, that's the short-term rates, those rates are coming down, so that's good. However, borrowing rates are staying elevated. So if you're looking to expand, buy a plant, something, or do an expansion of some sort, you might be borrowing, those rates are still high. And so it's a very confusing time. And ultimately, we have seen stocks run up in value. And part of that is because of this Goldilocks sort of scenario that we're in. However, there's greater uncertainty and confusion about the road ahead. So that's the confusion. And I've been explaining this to clients as they've come in, because many clients that we're serving, they're either at retirement or in retirement. They've got a decent amount in cash and they're looking around saying, my 5% CD is about to come due and I can't find anything close to that. Or the cash reserve that I have in my money market is going down and down in interest rate. And yet, I just heard this morning, which is prompted again to say, gosh, I keep having this discussion. Let's put it out there for you to consider. The mortgage rate for their kids that they're looking at, buying a house, still 7% or so. So we've got this very strange phenomenon where, as a saver, as a lender, the interest that you're earning has gone down significantly and likely will continue to do so depending on how the Fed acts from here. But then borrowing rates are staying elevated simply because we were running such a high deficit and continuing to borrow so much as a country that long-term rates or borrowing rates are staying elevated. Work with your certified financial planner. See how to optimize this in your situation. One, making sure that you've got the right amount of cash and it's structured the right way so that you can get the right amount of interest for you. And two, re-examine your borrowing strategies, whether that's for a loan or a mortgage or a car loan, something like that. Evaluate, well, what would wisdom do? What makes sense for your financial situation? And lastly, figure out the right strategy to manage risk in your investments. This phenomenon, this strange time period that we're in with interest rates, could last a lot longer than any of us would want. And that's going to create some havoc, some confusion in the equity markets for owners. And so make sure you're managing risk well there. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go on, take your next wise step in your financial life.